Hello, everybody. My name is Aryan, Director of Phoenix Financial, and this is episode 1 of the Phoenix Financial podcast. I've got over here Alankar Ghosh, recent university graduate, looking to enter the property market for the first time and buy his first property, and is deciding whether to buy an investment property or his first home. Nice to have you, Alan.
Thank you for having me, Aryan.
Yep,
It's quite the pleasure.
No worries at all. So, tell me a little bit about yourself. What made you come to Phoenix and what you're looking to do?
Yeah. So you've already introduced me, so there's not much to say. I have recently graduated from university, looking for a new place to buy. Honestly, pretty open to either if it's an investment property or if it's a place to stay. But I think a lot of people my age, and you're probably familiar with this, dealing with clients, they are very confused on how to approach buying their first property, their first home. I approached you guys because you've had, although you are an earlier, younger company, you've had a stellar record with your clients, fantastic reviews from what I've understood. And you've certainly helped me in trying to navigate my way through the housing market. So with your help and with my own research, I've come to you guys to try and look for a place to buy. But yeah, that's pretty much how we met, essentially.
Absolutely. So you did express your concerns and your challenges that you've been facing in the last couple of years. The abundance of information out there.
100%.
Not too sure what you're supposed to do, what your first step should be. You've been told several times, I need 20% as a deposit. Some people tell you can get in with a 5%. Some people say you don't need any deposit at all.
Yeah, the numbers are very arbitrary. I don't know, like every year you hear someone says, like you said, like 5%. Some people say no deposit. Some people say don't even bother. You're not going to be able to buy property, which is very demoralizing.
Yeah.
But yeah. Well, what are your thoughts on that? How should we exactly approach it? What's your ballpark figure? What do you think should be the appropriate deposit? Where should people go to get information on how to approach their first investment?
Absolutely. So that's where we come in play, right? I think the main thing is the market has changed so much in the last few years. And what we're seeing now is just people are just not able to access the market with the same ease and convenience that they used to many years ago.
Yeah.
Right? And what we're finding is that a lot of our buyers are just struggling. Like when they come in, they've usually run their numbers on a bank's website, run their borrowing capacity, and they come to us and say, oh, Aryan, I'm making so-and-so money, but I can only borrow 400K.
Yeah.
And as you would know with the Sydney property market, 400K doesn't really get you much anymore.
No, it barely gets you an apartment nowadays.
Yeah. And it's about understanding that the way to get your goals now has really changed to what it used to be years ago. So what we used to look at like many years ago was that essentially buying a property used to be only 4 to 5 times your annual income.
Right.
Nowadays, for the median income, it is essentially that buying a property is usually around 12 times your annual income.
So the margin has increased by a lot.
It's increased significantly.
Right.
We've seen that wage growth itself, just in Sydney itself, has been only around 27% in the last 10 years.
It has, like the minimum wage has upped recently though. Like
It has
I think
upped.
last year it was around like 3-4%, and then this year is going to be another 3.5% or something.
Yeah, see, exactly right. But the thing is, when you compare that with the prices of property,
Right.
you'll find that 27% compared to Sydney's prices in the last 10 years of over 90%. We've seen a close to 95% uprise in property prices is quite significant.
Yeah.
And that affordability is just not there for our buyers anymore.
Yeah, especially younger buyers, I would imagine, because they're just entering the market. They don't have any income at the moment. Most people don't, even if they're working part-time. Like I can tell from my point of view, like my perspective.
Yeah.
Like when I first graduated uni, I was working part-time as well. Not crazy hours, but just enough. And I think I saved up more than most people do. But even then, it just seemed like it's just an astronomical difference between what I have and then what you actually need to get in.
Exactly right. And I would say as well, like, think of it as today, if you were a single individual buying your first property, you had zero debt. Not even, like, let's pretend you have no HEX debt as well, which most graduates these days do have HEX debt, but just for the sake of convenience,
Best case scenario.
There's zero debt whatsoever.
Yep.
You're making 90K, which is a pretty good income as a graduate. Right? Let's say, hypothetically, you've got the 20% deposit as well. So this is best case scenario. The banks would only lend you 500K for an owner-occupied property. Right? Which, like I said, if you were to buy a property today using 500K plus your 20% deposit, you're effectively getting in somewhere around the 700K mark, right?
Okay.
Which is good. You could still buy an apartment, but that Australian dream of buying your first property which is a house with your large land size, your good backyard.
Yep.
That's very unachievable today.
Yes. Yeah. I think a lot of people, I do hate to bring politics into this, but I think in the past election, that was like one of the biggest gripe a lot of young people had, that the so-called Australian dream, I know it's not put in that frame, but that dream is not achievable in this lifetime for this generation. And I feel like there's a lot of angst because of that, a lot of frustration. Like, we were promised something, and then that promise we know for a fact can't be delivered.
See, that's where we come in. It's not about it can't be delivered. It's about the way to navigate to get there is very different compared to what it used to be. Right?
So you're saying it's still possible?
It is still possible.
Okay.
Right? And the government is doing quite a good job about it with everything that is in play. Like, when there is inflation at this magnitude, there's only so much that can be done. But there are quite a lot of government incentives, both by the state governments and by federal, that have taken effect that essentially do help people get in with a significantly smaller deposit, and also with things like stamp duty exemptions, which can save clients close to $30,000 in just tax, stamp duty, transfer duty. Yeah.
Okay.
So essentially, when it comes into play, like, what we tend to say is that buying a property is still achievable for Australians, but now it comes into, if you've got only 90K in income, what is the best way to use that 90K?
You got to be smart about it.
You got to be smart about it.
Okay.
Now, a lot of people just want to achieve the Australian dream. They want to buy their first home. They want to move into it. But we get a lot of people like yourself who come to us and they just want to find the best way to accumulate wealth.
Yeah.
Right? And that's where we kind of talk to a lot of our buyers about rent vesting. Right?
Rent vesting.
Correct.
Okay. Is this a new term?
I wouldn't really say it's a new term, but it's something that has been
It's been on the high
exactly
in recent years.
Especially with, like I said, the affordability of buying a house being so high. But people still want to build their wealth. Right?
Yeah.
Properties, as you know, are one of the best assets for constant appreciation.
100%. Yeah.
Land just appreciates, right? So whether you buy today or you bought 10 years ago or 10 years later, that land will just continue to appreciate.
Right. So at any point you buy, it's just going to go up. Land specifically, though.
Exactly. Majority of the time, exactly right. The land will just keep appreciating.
Okay.
Right? So it's about entering the market and finding the best way to find those properties which have the highest capital growth, but also deliver that sort of rental yield that you're actually able to build a portfolio of property. So now coming back to that whole point of, if you had 90K in income, no debt, what would be the best way to go? And you've got your 20% deposit. I said you could borrow 500K, correct?
Yes.
500K might not be able to get you much. It might not be able to get you your dream home.
Right.
But as an investment property, you can borrow up to 900K, maybe even more, right? Depending on the rental yield of the property that you end up buying.
So you're saying that instead of buying it as like a home to live in, you buy it as an investment property first.
Exactly right.
So your first property should be an investment property. Is that?
It's more about, it's about your individual goal.
Okay.
Right? When you've got 90K in income, you're a single applicant.
Yeah.
And you want to figure out what's the best way to enter the market. We first discuss what is your personal goal.
Okay.
Would you be happy to be renting for a while. Tell me a little bit about yourself. So are you currently renting or living with family at the moment?
Currently, I'm living with my family.
Currently living with family. I'm assuming no rental expenses at the moment?
No rental expenses.
No rental expenses. So you're in that prime point where essentially you've got no debt, you've got no expenses.
Yeah.
And you're at that point where you're in that accumulation phase. You can just go in and buy property without any sort of hesitation in terms of risk.
Okay.
Right. Now we come back to how do you get into a property? Because you've got 900K borrowing capacity effectively.
For an investment.
Correct.
Yeah.
But let's just say you were to buy a 900K property, right? Everybody tells you need a 20% deposit.
Yes.
What is 20% of 900K? 180K. Plus stamp duty.
Yeah. Yeah, that cost starts
Another 30K.
And then there's the LMI as well, the lender's mortgage insurance.
Mortgage insurance if you go less than 20% deposit.
Right.
Right. So there's always some sort of downside. Right.
Yeah.
So when people come to us, that's where they're stuck. They don't know what to do.
That's where people get more hesitant because there's too many cons, whichever way you go.
There's too much going on.
Yeah.
And nobody knows what's the best way to do it.
Yeah.
But the way that banks have designed their policies, the way the government has designed policies, and the way that the federal government as well and state government have designed their policies to help first-time both owner-occupiers and investors is quite great. And it does allow for people, especially Australians, Australian residents, permanent residents, and Australian citizens, to really access the market. So tell me this, do your parents currently own property in Australia?
They do, the one we live in.
Perfect, right? One of the things that the banks do offer these days is something called a guarantor home loan. Okay. Are you aware of those, how they work?
Familiar with the term.
The way a guarantor loan works is effectively you purchase a property. Now, I told you can buy, let's just say, a 900K property tomorrow. Okay. But that deposit's the hard part, right? Saving up that 20%, not fun, right? Even if you were going to go for 10%, 90K is quite a lot of money, right? Throw in the stamp duty on top of that because if it's an investment property, you are paying that stamp duty because you're not a first home buyer for the intention of moving into the property.
Right.
So you're paying all those costs and you might say saving up over 100K is very difficult, right? Because that is more than your annual income. And after taxes, it's closer to maybe 2 full years of income without any expenses, which is quite a lot of money.
Yeah, right? That's a way too ideal situation.
Yeah, so what we tend to say to people is that maybe your parents own property, right? Maybe your brother owns property, maybe your sister owns property, maybe your grandparents in Australia own property, right? A lot of the time, these properties, they've already appreciated quite a bit from when your parents would have bought these properties. And they might be debt-free or very close to being debt-free, right? So there's quite a lot of equity there. Now, do you know the reason why banks say we need a 20% deposit or a 10% deposit or 5%?
I think they want it as an insurance of some sort. Even if it depreciates, they have something they can fall back on.
Exactly right. It's a bit of collateral.
Yeah,
right?
That's the term.
So
yeah, collateral. David, you know my financial literacy. It's not great.
Yeah, so it's about making sure, right, that the bank is protected.
Yeah.
Right. So when you put a 20% deposit down, the bank is effectively looking at that and they're saying, okay, Alan is serious about this property. He's invested a lot of his own money into it. We're happy to give 80% for this property as well. An absolute worst case scenario, if something was to happen, if Alan did start defaulting a bunch, we've got this property and we can sell this property if need be and bring back our money. And most likely, this property would never depreciate more than 20%.
Right.
So if they were to sell the property, they would make their money back.
Right.
Now, when you go under 20%, the risk to the bank becomes even higher.
Yeah.
Because if you put in a 5% deposit, their variation, the bank is lending you 95% of that property value. If this property was to depreciate by just 5%, and by depreciate I mean if they had to flash sell the property because for whatever reason you started defaulting quite a bunch, there was a financial distress, like these are all things that could happen, right? What will happen is essentially the bank is under a lot of scrutiny. The bank is under a lot of risk, right? So that's when they charge lender's mortgage insurance. The lender's mortgage insurance is more about protecting the bank than protecting you.
Right.
Right. Now, where a guarantor comes in play is what the banks want. It's just equity, right? The bank just wants to see that they're protected. If you borrow 900K for a property and 80% of it is secured against the property you just bought, and then 20% is secured against your parents' property, obviously with permission from your parents and with that independent legal advice as well.
Yeah.
The bank is happy because their money is secured.
Right, and you're taking the rest of the risk, but technically, because it's property, it's going to appreciate.
Exactly
generally.
right. Exactly right.
So, hypothetically, and correct me if I'm wrong, hypothetically, you're essentially getting a loan risk-free.
See, there's always a little bit of risk. Right?
Of course,
It's not about a risk-free.
Like a massive reduction in the amount of
risk.
Okay.
Because property is an asset, right?
Yeah.
It's not like any other unsecured sort of loan.
Yeah.
Which is why banks can provide these sort of services with very low interest rates, right? Because the risk factor is quite low.
Yeah.
Right. It's not zero, right? But there is an asset attached to it. So effectively entering the market is not the most difficult thing depending on your current circumstances, right? Now you might be asking, okay, I've got a parent that owns property. What about all the Australians that don't have family that owns property, right? That's where the government incentives come in play.
Right.
Right.
I think with the recent elections, with the new term of the Labor, there's been a couple of incentives that have come through. They've been playing on it a lot during the elections. I think there was something for first home buyers. You're probably more familiar with this. It's something to help first home buyers get their home even if they don't have property. Was there something like that?
Yeah, so exactly right. So you've got these incentives now.
Yeah.
Such as the first home guarantee scheme. Right?
Yeah.
Which is effectively entering the market with just a 5% deposit. Right?
So not the massive 20% you were talking about.
Not the massive 20%.
Just 5.
And no lender's mortgage insurance.
Okay. All right.
Which effectively means you are saving thousands of dollars. Currently in New South Wales, this scheme is going up for properties up to 900K.
Up to 900K.
Up to 900K.
Okay. Right.
Which effectively means that you could buy a property tomorrow with close to just 45K in the bank.
Ooh, okay.
The reason for that is you're getting it with a 5% deposit.
Right.
And for first home buyers, you're effectively avoiding or coming very close to avoiding stamp duty.
Okay,
right?
yep.
So the rules in, let's just say for New South Wales, for first home buyers is up to 800K. So I'm just going to correct what I said previously, right? Not 900K with 45K. Let's say 800K.
800K.
With 40K.
With 40K. Okay, yeah.
Right? Because the stamp duty exemption rules in Australia, in New South Wales, are that you can buy an 800K property with $0 stamp duty.
And if it's more than 800K?
If it's more than 800K, it's still quite good because 800K to $1 million, you pay a concessional stamp duty.
So it's at a reduced rate?
It's at a reduced rate.
Okay.
Right?
All right.
Once you go over $1 million, you are still paying the full stamp duty.
Right.
And all of these rules differ based on the state, which we'll put a table up for our viewers so they can see all the different.
That would be helpful, yeah.
Yeah. But essentially, you can get in with effectively no stamp duty, which is a massive cost because
how much does stamp duty normally
Absolutely,
take away?
Good question. Stamp duty for a 900K property is very close to around the 30K mark.
Ooh.
which is a lot of money.
Okay, fair enough. You
Yeah.
can buy a new car with that.
It's close to your 5% deposit.
Yeah.
Yeah.
Okay, no, fair enough.
So
And you're saying if it's within 800k, you can get rid of, you can waive
you
off
can
30k.
just waive that stamp duty cost altogether.
That's really good then. Okay.
So you're effectively getting into these properties, an 800k property with just 40k in the bank.
All right. Yeah.
What more could you ask for?
That I think that's a really good way to enter into the market then.
Yeah.
No stamp duty, just a 5% deposit, so not a crazy 20%, and a fairly modest piece of property. But what's the catch to this? This can't be an investment. This is if you want to live there.
You have to be living in the property.
Okay.
Now, it can become an investment in the future, right?
Right.
But you do have to live in this property.
Temporarily, at least. All right. So you mentioned like the family home guarantee and how you can get the 5% and stuff. But
Yep.
how exactly are you eligible for it?
Yeah, so first home guarantee, right? So there's two
Yeah.
different ones, family home guarantity and first home guarantee. So it's good you brought that up actually, right?
All right. Okay.
First home guarantee is a 5% deposit,
5%
no
deposit.
lender's
okay.
mortgage insurance,
No
right?
lender's mortgage insurance. No LMI.
No LMI.
Okay.
Right? And to be eligible for that, it is effectively that you need to be an Australian citizen or permanent resident.
Or permanent resident. Okay.
Correct, yep. So many Australians, right?
Yep.
You need to be making, as per your 2024 notice of assessment, so the previous year financial year.
Previous financial year. Yeah.
So we're about to come into the next financial year, so it
Yep.
will become the 2025 notice of assessment.
Yep.
Which is the document that you get once you complete your taxes.
Okay.
That
yep.
shows your taxable income for that previous financial year.
Yeah.
That needs to show that you made 125k or less.
Or less. Not more. Less.
Not more, less.
Okay. So 125,000 is the cap.
Is the cap for a single applicant, or for a couple, 200k.
Okay. So
Yep.
individual, 125,000 or less.
Yep.
A couple, do they whatever? A couple, 200k or less.
That's correct, right?
Okay.
And the reason why they do it that way is because it's supposed to incentivize affordability,
Yeah.
right? So it's made for people. 125k is not a small wage by any means.
No.
It's actually it's above the median,
Yes.
right? But with the rising house prices,
It kind of gets you in the
helps you get
entry
into
level.
the market.
Right.
Now, the good thing as well is it's not just that you have to have shown like less than 125k. You could have made 125k or less last financial year, but be making 300k or so this financial year. That's fine.
That's fine.
That's fine.
So you
just
could
have
have
to-
made more. Your financial situation could be better.
It could
and
have
you're
improved.
still eligible.
You're still eligible as long as you can show that in the last financial year, as per your taxable income, you made less than 125k.
Okay. So your taxable income has to show less than 125,000 or less.
That is correct.
Even if your financial situation is better.
Exactly right.
Okay. So there are loopholes of sorts to this.
There are loopholes.
Right.
Now, on top of that,
Mm-hmm.
right, you need to be intending to live in the property. That's very important.
Okay. So you have to buy it as a place of residence.
You have to buy as a place of residence. And this comes into the stamp duty exemption as well.
Mm-hmm.
So for the stamp duty exemption that we were talking about, you need to move into this is for New South Wales. Every state differs a little bit.
Yeah.
But for conversation's sake, for New South Wales, you have to move into the property within 12 months of buying it,
Okay. Yeah.
and then live there for a minimum of 12 months.
Okay.
Yep. So when I was saying that you could still buy a property and make it an investment in the future, or start it off as an investment and then move into it within 12 months, those sort of options are still available,
Right.
right? It's more just about, to be eligible for that stamp duty exemption, you do have to meet that criteria.
So that's the pretty much the hard and fast rule. You have
That's
to
the
meet the
hard and fast
criteria, otherwise from there it's kind of flexible
Exactly right.
within that sort of 12-month-ish period.
Exactly right. Now, when you come to these first-term guarantees, what you're looking at is that there are certain price caps as well,
Yep.
right? So, and
You
we'll put
mentioned
that
800. You mentioned 800 grand, I think,
800K is for the stamp duty exemption.
for the stamp duty. Okay.
Now, we'll talk about New South Wales, but I'll put the table up again
Yep.
for all of the other states.
Yep.
Right? Because every state differs quite a bit. And the reason they do that is because property prices differ in every state.
Yes.
Sydney, New South Wales is one of the most expensive states.
In the world, I think. I think Sydney's one of the most expensive cities in the world.
Exactly right, yeah. Which is not great for us, to be honest.
Yeah, it is what it is, I suppose. Yeah.
But effectively, like, in New South Wales, to be eligible for that first-term guarantee,
Yeah.
in the metro regions, the property must be 900K or under.
Right. Okay.
And in regional, 700. Right?
Okay. Yeah.
Now, you can find properties in that price range. Right?
Mm-hmm.
If you're a first-time buyer, you could buy an apartment in 900K or under. No issues. You could find houses in that price range as well.
Mm-hmm.
Townhouses, definitely. So it's definitely a really good policy. And with the Labour government winning the election very recently, they did even propose potentially increasing that from 900K all the way up to 1.5 million.
I think they did. I think they said later this year or maybe start of next financial year, they're thinking of upping that price range to like $1 million or just getting rid of the price cap entirely. I don't quite remember.
Yeah, and I think like
it is still good news overall.
It's great news, and obviously like we don't know if it's actually going to come into effect.
Yep, that is.
But it is
true.
great news for our first-time buyers.
Yeah,
because a lot of the time that deposit is the hardest part,
mm-hmm.
especially when you've got two individuals. A lot of these properties, when you're looking to buy a place to move into, would be done with co-borrowers, two people making an income.
Yeah.
So from that aspect, maybe the affordability isn't too bad from the bank's perspective, getting that loan. But that deposit is so difficult.
Yeah.
With living expenses so high.
Especially nowadays, like post-COVID, I don't know what happened after COVID, but living expenses just skyrocketed for no reason. We had the whole egg thing because like bird flu or something.
Oh, I remember when eggs used to be like $3.
Why? I did not have omelets for like at least 3 or 4 months.
Yeah, I walked into Coles the other day. $9.
$9. Nah. I'm not that desperate for eggs. I'm not that desperate.
I think it's where we're headed though. And unfortunately, it didn't just apply to eggs; it applied to properties as well.
Yeah, yeah. Nothing's exempt.
Nothing's the same anymore, right? So, obviously, getting into the market, if you are a co-borrower, if you got two incomes, two people making 80 to 90K each, entering that market is not the most difficult thing, right? In terms of getting the finances.
Yep.
But getting the deposit saved up.
That's the biggest hurdle.
That is very difficult, right? And if you are going, let's just say they do increase the first-term guarantee to 1.5 million.
Yep.
You would still have to pay stamp duty on that because that stamp duty exemption doesn't go all the way up to 1.5 million. At least not yet. Hopefully, they increase in the future.
We'll have to see that. That's kind of on the fence.
But there are upsides and downsides to them doing that as well, which is more of an economic sort of argument, which people do say that, yes, if they do implement all of these policies, wouldn't that just boost the house prices all over again?
I have seen that argument, yeah.
Yeah. Because
I think
higher demand for these properties.
Yeah.
Sorry, go on.
Sorry, I was just going to say, there's like two people on two sides of the fence. They say like, oh, even if it does increase, it's not going to be significant. So like you might as well still buy property. It's going to be great for everyone else. But then other people are just like, no, it's going to skyrocket. We're just going to have the same problem for a new generation.
Exactly.
Right. I think us growing up in this generation, we don't want to repeat the same mistakes that our forebears did.
Yeah.
I think most of us agree on that front.
Yeah. I think that you raise an interesting point because people in our generation, right, don't own much of Australia's wealth at all.
Yeah.
If you look at people under the age of 35 in Australia, households aged under 35 only own close to 5% of total Australian wealth.
Only 5?
Only 5.
Of the whole of Australia? Only 5?
Whole of Australia. Right. Now, on top of that, right, there is a massive wealth disparity in Australia as well.
Yep.
If you look at, let's break that down even further.
Okay.
People under the age of 35. The top 10% off that under 35 bracket,
Yep.
their net wealth, their wealth was estimated roughly at around the 920K mark in 2003.
Their
This is
total worth, or is like the average?
This is total for like the top 10%.
The total for the top 10 under 35
was around the average of around the 920K mark.
Is the average of an average 20K.
Yep.
So that's not the net, that's the average.
Exactly.
Okay.
This was 20 years ago, right?
Oh, okay.
2023, it was estimated that same under 35, $2 million, right? Which means effectively 125% growth in those 20 years.
20 years, okay.
Compare that to the bottom 60% of people under 35.
Okay.
The average wealth was in 2003, 68K, right?
Okay. That's not
too
bad. It's livable.
It went to 80K in 2023. So
That doesn't seem big. that does not seem big at all.
Only a 17% growth, 70% uprise for the bottom 60%. So you can see that wealth disparity.
And it's probably just going to get bigger.
It's just going to get bigger, right? Because, like I mentioned as well, the ability to access property now is so much more difficult. How much were people buying properties for in 1970? Well, I've got those numbers here, right?
Right.
In Sydney, right, the median house price in 1975 was close to 35K.
35.
35K.
House and land, or just house?
Everything.
House, land,
everything.
The Australian dream was 35K.
The Australian dream was 35K.
Okay.
Can you take a guess what the median price in 2024 is for in Sydney?
In Sydney,
house price. Not apartment price, house price.
I'm going to guess 1.2 mil.
You would think so, right? Higher.
1.5?
Higher.
Higher than
1.627 million.
Oh my God.
1.627 million. That is a 4,645% increase.
4,000?
Since 1975.
That's the kind of number I get from my math test when I did it wrong. Okay? What do you mean 4,000%?
Yeah, so see, a deposit of 60K,
right,
which might have been enough years ago, now only represents close to 3 to 5%. Right?
Ooh, okay.
So it's very much changed. And where is this heading, essentially? Right? Median house prices in major cities have risen 200 to 400K in just the past 3 to 5 years. Right? So it's not stopping, right? Which is why and where we come in play, right? At the end of the day, it's not just about helping Australians buy homes. It's about helping Australians build wealth.
Yep.
Right? Because that wealth disparity, we need to bridge that gap, essentially.
Yep.
Right? And as I mentioned, everybody can access the property market. It's just about finding the right avenue to get in. Right? If you bought a property today, and we've seen this sort of growth in like the last few years, especially just post-COVID, we have seen a lot of our clients buy properties for 700-800K that just in 2 years are worth close to the $1 million mark.
In 2 years.
In 2 years.
It just appreciated to $1 million. 700 to 800.
700 to 800K.
So I'm just going to pause you here, but if, for example, we were to use the process you explained for the first home guarantee, we lived in it for a year, and now we decide to use it as an investment property. You're saying what we bought for, let's say 900K, so we don't get a stamp duty exemption, but
you get a stamp duty
we do get a stamp duty exemption, you're right.
Depending on the state you're buying in.
Depending on the state. But let's say it's in New South Wales.
Yeah.
We bought it for 900K, we've lived in it for a year, we chuck it as an investment property afterwards. You're saying that that property may have appreciated to $1 million within that year or 2 years?
Exactly. Yeah, so finding the right property, right? That's the most important thing when it comes to accumulating that wealth.
Right.
Many Australians, like yourself, when you came to us, just very confused by the abundance of information out there.
Yep.
You didn't know you would see all these developments happening all around you. You would see brand new properties, brand new metro station.
Actually, I want to cut you there.
Yes.
For the audience, currently I live in Parramatta, around that area. There's always some sort of development happening. Like, I go maybe 5 minutes down the street and I see this new building being built, and there's always this kind of pressure like, oh, I need to get into the property market ASAP, I need to get into the property market ASAP. But I think on top of that, what I wanted to add to what you were saying, like on top of all this information overload, there's this pressure inside that I need to get in as soon as possible, otherwise it's going to be out of my reach.
So there is some truth in that, but not completely. Right.
Okay.
As you know as well, there are a whole bunch of government schemes.
Yep.
There's a whole bunch of incentives coming in.
Yep.
You've done your own research on some of them.
Yes.
That you were telling me about before. If you want to elaborate.
So what I found outside of the ones that you mentioned, like the first home buyer assistance and the first home guarantee, the Labor government recently announced something. I won't say recently, but during the election, they announced something known as, let me just figure that out, Help to Buy. Help to Buy scheme, which is planned to roll out near the end of this year, where essentially it's going to be established, I think, in the major states. I could be wrong. But the government contributes up to 40% of the total cost of a new house, or 30% of the total cost to an existing house, and you only contribute 2% as a deposit, and you're exempt from paying the lender's mortgage insurance. But the government owns part of your house, but you can pay that off slowly as well.
Absolutely.
So, like you said, on one hand, there is some truth to it, like there is that pressure, but it's sort of easing up as well from the looks of it, or at least the barrier to entry is a little bit lower than before.
There's two sides to it, right? There are always going to be government incentives coming in play.
Okay, yeah.
Right? But it's only going to get the types of property you're able to buy, what you're able to achieve is going to dramatically change in the coming years. It's already changed quite a lot from like when you would buy properties in 1975 versus now.
Yeah.
When I said you could buy property for 35K back then versus today, 1.6 million. When you look at a property today, you're not looking at a 700-800 square meter of land block. A lot of properties these days are going for maybe 300 to 400 square meters. Right?
Yep.
So you're not actually getting that much land as well.
So you're paying more for less.
More for less.
Right.
You're also seeing, like you said, you're seeing massive developments in Parramatta.
Yeah.
You're
Most of them are apartments.
Apartments, right? Yeah. So that dream of actually buying a house with your own backyard, with your own land, that dream is kind of diminishing over time, right? And it's about understanding that it's still possible, but it's not.
It's not going to be the same.
It's not the same. It's not accessible in the terms of in the markets that you would want to get in these days, right?
Yep.
I had a client come to me the other day, and he said, "Aaron, I want to invest. My son wants to invest, sorry. And I bought this place in Seven Hills for $700K in 2017.
Okay, yep.
I would want my son to buy as well, right? I took a look at the market in Seven Hills, and I said, it's not 2017 anymore, right? Which is, there's big truth to that.
Yep.
Properties have just appreciated so much that these properties now are well over $1 million.
Well over.
1.2, 1.3.
Okay. Right.
Even if you were to access, it would be maybe
so this is something like properties that were, let's say, a decade ago, they were built. They're now very much, for the most part, unobtainable. They're not as easily obtainable. I shouldn't say
not unobtainable, but not as easily accessible.
Yeah.
Right? Now, there are two sides to it, right? If you've got two owners with 120K each, buying a property around 1.2 million, still achievable, right? But for young Australians, there's two sides, so there's two goals that should be there. It's about, yes, we want to buy a dream home.
Yep.
Right? And why do you want to buy a dream home? Yes, there's the emotional aspect to it. Mm-hmm. But it's also one of the only assets in Australia, your own home, where you don't really pay any tax on it.
Mm.
When you buy a property that you live in, one day when you sell it, let's just say 20 years later, you won't have to pay a drop of capital gains tax whatsoever on that property.
Mm-hmm.
Right? So your own home, when you do end up purchasing it, is your biggest asset in terms of the capital growth on that.
Versus how much tax or
Exactly.
other costs associated with it.
Yeah, but the downsides to it is if you are buying your own home and you're taking out an abundance of debt on that property,
Yep.
you've effectively reduced your borrowing capacity completely. Because as you own that property, while you hold that property, before you sell it,
You can't really go for anything else.
You're getting no tax incentives while you hold it.
Mm-hmm.
So when you own an investment property,
Yep.
when that property is making a loss,
Mm-hmm.
you're able to claim those losses. Negative gearing.
With an investment property.
Correct.
Right.
An investment property is able to generate rental income.
Right.
And as that property appreciates, yes, if you sell that property, you may have to pay capital gains tax. But you're able to keep leveraging that property, drawing out more equity and building a bigger portfolio.
Mm-hmm.
Right? So when I talked about that wealth disparity in Australia, one of the ways to combat that in Australia is what I discussed before, rent vesting.
Rent vesting.
Right. Which is effectively living with family or renting a property.
Mm-hmm.
Renting your dream home if you really want to.
Right.
And accumulating wealth on the side.
With an
Building
investment
your
property.
Exactly. Investment properties, because you
Multiple,
have that potential.
Yeah, because you can draw the equity from it.
Exactly right. And over time, it's about taking that dream of buying your own personal property and delaying it slightly, right? So that you are able to achieve that dream in a smarter fashion by building up a base of wealth,
Mm-hmm.
and then eventually potentially selling or drawing out equity from your existing portfolio,
Mm-hmm.
and using that to buy your principal place of residence.
Okay.
So by that point, you've got multiple properties and you've built up that portfolio of wealth, and you're setting yourself up effectively for retirement. You're setting yourself up for your future family, right? So it's about figuring out what's the best way to accumulate wealth today. Because if you bought, like I said, let's just say your borrowing capacity today, 500K on a 90K income.
Yeah.
Let's say even if it was $1 million, let's say there's two people. As I mentioned, the median house
$1
price.
million income?
No, $1 million borrowing capacity.
Okay. I was like, $1 million
No, $1 million
income. Oh,
that
I'm
would be
chilling.
amazing. $1 million income, I'll tell you to buy all of Sydney. But, yeah, let's just say you had $1 million in borrowing capacity.
Yeah.
I told you that the median house price is 1.6 million.
Right.
Right. If you went, let's just say you had your 600K deposit.
Mm-hmm.
Let's say you had the cash for the stamp duty.
Mm-hmm.
Once you buy that dream home, then what?
You don't have anything else. You don't have
There's
any
nothing else
equity
left,
to
right?
draw from. Yeah.
Then it's about investing in other things.
Yeah.
And yes, there are things that are quite good to invest in. You could invest in shares.
Right.
You could invest in index funds. Right.
What about art? See art going around.
That's not for me.
That's not for you.
That's
Can't
not for
speak.
me.
Can't speak on that. Can't speak
Not
on
an
that.
expert in that matter, unfortunately. But
I want to sound fancy. I want to be posh.
But effectively, yes, like once you do buy your own place of residence, you've got your dream home, but it's the dream. You should be working to achieve that. But once you achieve it, then what?
Right. So what you're essentially saying, it would be smarter, as a younger person who's entering the property market, it would be smarter for you to delay the idea of moving out into your place of residence as soon as possible. Because quite frankly, that's an old school thing.
That was the Australian dream.
That was the Australian dream.
And again, it's not, I would never say I look down upon it, right? It should still be the dream.
It's just not as feasible as it was before.
It's not as feasible as it was before. And you also have to think about, where do you want to be in 10 years, 20 years, 30 years?
You have to play the long game.
How old are you today? Right? Where do you want to be in terms of passive income in the next 10, 20 years? Right? Because, right, apologies for that. The camera battery just died. But coming back to what we were talking about, buying the first property, you have to be smart about it, right? You have to be smart about it because it is your access to building your wealth.
Yeah.
Right? When you think about buying a property, like we've mentioned so many times, you need to have your 20%. If you don't have your 20%, you need to have either 10 or 5 or 0, but you're using a family member.
Right. But you need to have some sort of deposit of sorts.
Exactly. But the main thing about these government schemes is you can only use them once.
Yeah.
Once you've bought your property, you can't go and say, I want to use the first home guarantee again.
Because you've already bought your first property.
It's not a first home anymore.
Yeah.
Same thing with the guarantor sort of deals, right? You can use a guarantor for an investment or an owner-occupied property, but only your first property.
Right. After that, no.
Yeah. So the goal is for wealth accumulation, buying the property that, one, gives you the growth, that you're able to keep drawing out equity, but also finding that sort of rental income that will service that loan.
Over time.
Over time. Correct.
I want to just take us back a bit, maybe forward a bit, into young people trying to buy their first home.
Yep.
So not investment property, but their first home. I think a lot of younger people, and younger people I'm using as a very loose term here. I'm talking about people who are like in their 35s, 40s. You all are young. I'm not saying you're not. Maybe I'm saying you're not. But a lot of people want to buy their first home in a place where they grew up. Yes. So I've spent most of my life around the Parramatta area. I want to buy my first home in the Parramatta area.
Yeah.
But slowly but surely, it becomes harder and harder and more inaccessible.
Yeah.
And I think there's a bit of a sentimental side to this.
Yeah.
That, I can't buy where I want to buy. I have to go outside of this region and buy for the sake of buying. Kind of how I was talking about, there's this pressure to buy. So you combine those two and you're just buying for the sake of buying. So do you, as a mortgage broker, deal with these aspects that clients may want, these sentimental aspects? Is there any way you address them, or how would you recommend that we approach these sort of, I suppose, thoughts as clients?
Absolutely. So there is a sentimental value, right? Like when you are buying your first home, you do want to live in areas that are relatable to you, that you have grown up. Mm-hmm. If I told you tomorrow that, yes, you could buy a home, a full house, 600 square meters of land, but you had to go a little bit more regional, or you had to go to another state, yes, you could do it, but you probably wouldn't want to.
Most likely.
The main thing that you have to tackle is that, do you want to own this home, or do you just want to live there? Because they're two different questions, right?
How so?
If you want to live in Parramatta, why not rent in Parramatta?
Okay, yeah. I see where you're going with this.
So, essentially, home ownership in Australia...
But what if I want to have a home in Parramatta?
If you do want to have a home in Parramatta, at this point, it's still achievable, right? But as we discussed, properties in Parramatta, as you mentioned as well, there is a lot of development happening here, right? The types of homes that you would have been able to access years ago
are not as accessible.
So
you just got to be realistic about it.
Yeah, if area really does matter to you, apartments are there, Development just keeps happening. I would say in the last 10 years, several new apartment complexes have just come up in Parramatta.
Yeah.
Many.
Yeah.
Right. There's a metro station under development in Parramatta now.
Yeah.
Right. So the new light rail just finished very recently.
I did.
So the amount of development happening in these areas is quite substantial. And the reason for that is there is a lot of demand for people that want to live in these areas.
Yeah.
Right. So it is about understanding what is your goal essentially? Because buying a property in Parramatta or buying a property in the place that you want to live, there's two sides to it. There's the emotional investment and there's the correct strategic choice for wealth accumulation. Right.
Mm-hmm.
So I get a lot of buyers that come in that say, hey, Arian, all these properties have come in Rouse Hill, in Schofields, that they look amazing. If you visit these properties, they're fully furnished, they're brand new, they look really, really good.
Just off the plan and everything.
Yeah, brand new apartments. Right.
Apartments, not on property.
There are houses too. If you go to the Box Hill side, you'll see several properties.
Yep.
Right. What's the issue with these properties? How much development has happened? Right. These properties were made, one, because the areas are becoming higher in demand.
Yep.
But two, because they also want to boost the affordability for first-time buyers.
Mm-hmm.
These apartments, you could buy them for around the 600-700K. But the amount of development that has happened, thousands of apartments have been built. Right. Are all these apartments filled? No. You go on realestate.com tomorrow. You search up Rouse Hill. You search up Schofields. You will find an abundance of properties. You search up the rental market. You'll find a bunch of these properties untenanted, right, ready to move into. These properties, essentially, they look amazing. They hit the checkboxes that many Australians think is what defines a good property, which, from an investment perspective, not really, right? When you're looking at a property, what do you look at? I'll ask you, generally speaking, when you think of a good investment opportunity, what are the characteristics you're looking at?
I'd say for an investment opportunity, I'd say how much rent can I pick up from this?
Yep.
That's one. Is it within affordability range? So how long it takes for me to pay off the loan for it? And maybe the potential value of it. So maybe looking at the locality or where it's located specifically. Is it easy to get to and from important infrastructure? So I don't know if there's shopping centers or train stations, things like that.
Okay, so you've hit a lot of the checkboxes.
Right.
There's a lot you've missed out on as well, right?
Fair enough.
So when you think of something like, let's just say Rouse Hill,
Yep.
right? Do you think of Rouse Hill? You've got the shopping center right there. You've got the brand new train station.
Yep.
Do you think of it as a really strong investment decision?
I would say yes.
You would, right?
Yeah.
And to some aspect, yes, right? Because you are getting the rental income.
Yeah.
But there are so many different criteria that I would call Rouse Hill an okay investment decision.
Okay.
Because you look at the price that you're buying these properties for.
Yep.
An apartment in Rouse Hill, 2-bedroom, maybe close to around the 700-800K mark, right? You take that same 700-800K, right? And you look at properties in Queensland. You look at properties in Victoria. You look at properties in Lake Macquarie, Newcastle. Right?
It's a bit outside of the general.
It's a little bit outside, but what you're looking at is not really, and again, these are just examples, right? And this data is constantly changing as well.
Yep.
But what you tend to look at, I wouldn't say fluctuating, but I would say where you bought 3 years ago might not be the best place to buy today, and where you buy today might not be the best place to buy 3 years later.
Okay.
And not because it's fluctuating in terms of house prices are going up or down.
Is it more development?
No, it's not even that. I would say it's more about cost to benefit sort of ratio, right?
Okay.
if you bought an 800K home today,
Yeah.
and that property was making roughly 800 per week rental yield, right? You're effectively close to that 4 to 5% rental yield, right? Which is quite good for a house. 3 years later, let's just say that house is worth 1.1 million.
Okay. Yep.
But you are still getting close to 800 to 850 per week rent. Would you still call it as good of an investment decision?
No.
No, right? That's basically what's happened in Sydney. These properties in Sydney these days, you're getting them for around 1.5 million.
Yep.
Right?
Sorry again.
That's so good. The rent on these properties are around 800 per week, maybe maximum 1,000. Right? Are they bad investment decisions? No. They will continue to appreciate. In the next few years, they might be worth 1.7, 1.8 million. Right? If you're buying in the right areas. But what could you have done with that 1.5 million? Buy 2 properties interstate.
Right.
Right. So it's about understanding how do you best use your money. If you go and buy a dream home, which was coming back to what we said earlier, you buy $1 million home. Now what? Right. You've got your home here, but and yes, it will continue to appreciate if you buy the right home as well in the right area.
Yeah.
But what else can you do? All your money is going towards the mortgage repayments.
Yeah.
Right.
Towards the mortgage.
And effectively, your scope of building wealth
has narrowed significantly.
You either have to improve your income significantly,
Yeah.
pay off a substantial amount of your debt, or downsize. Right? Like, there's no other way about it. Right?
You're just pretty much limited to those options if you were to go for a first home.
Exactly right.
But if you were to expand your scope a little bit, look at an investment property, then you have a wider scope of generating wealth. And then later on the line, maybe like 10 years down the line, which isn't too long, I'd say, but 10 years down the line, you can then look for a home to actually live in.
Exactly right, which is what we came back to at the start. It's about delaying, not delaying significantly, but delaying your goals. And you said 10 years. It's actually could be possible in 2 to 3 years.
Oh.
Depending on what you buy.
And how you go about doing it as well.
Like I said, we've had investors that have bought properties for 700-800K that have gone up, as per core logic data, to close to 1 to 1.1 million. Right? And that's taking advantage of 2 factors, like getting in before the boom and finding these properties with consistent growth, right? And then also these properties having really good rental yield that they're essentially supporting the buyer throughout this entire process. We get a lot of our investors that put their loans as well on interest only. Are you familiar with what interest only versus principal and interest is?
I am not.
So principal and interest is effectively you are paying down your loan.
Okay. Right.
You are paying down your loan because you borrowed 700K and you want to reduce that debt.
Yeah.
Interest only, you are borrowing money with the sole purpose of funding the asset, but you're not actually paying down the loan at all. You're just holding the asset and using the asset to just acquire more, continue to grow. Right?
So acquire more as in...
Acquire more property, acquire more wealth. Right.
And this is the kind of idea that like generating equity from the property, like the investment property that you were talking about.
Exactly right. Both ways generate equity.
Okay.
Right? But when you are paying principal and interest, let's just say I'll just make up some numbers now, but generally we tend to see that around interest-only repayments are roughly around $300 to $400 per month, less than principal and interest for, let's just say, like maybe like a 700K loan.
Okay.
Right. What that means is you've got that $300 to $400 in your pocket that you can continue to save for your next property.
Okay.
You've got that better cash flow.
You allocate for just interest only.
Yeah.
Just want to make sure I got this right. So for interest only, you're just paying $300 per month towards the loan.
No, not $300 per month.
How much was it?
You're paying, let's just say, close to $3,500, $3,700 per month.
The $3,500, let's say, per month. and then you have a certain amount of money left, which
Yeah,
otherwise
so
you would have paid for principal and interest combined.
if you were paying everything together, you
So
might
that's
be paying
principal
close
interest.
to 4,000 per month.
Right. So now you have like 500 extra that you can allocate towards something else.
You can allocate it to saving more.
Right.
These properties become closer to being positively geared, which effectively means that the properties are being paid for by the rental income coming in.
Yeah.
Because if you are making, let's just say 800 per week in rent, right? 800, if you take that as a monthly sort of income,
Yeah.
that comes to 3,466 per month.
Okay. Yeah.
Right. You're effectively paying close to $40 a month out of $40 a month out of pocket, which is nothing
Yeah.
for holding this property.
Yeah.
Which means that
That's
will
pretty
be-
much a coffee every day just saved up.
Exactly, which means that ability to keep scaling is a lot more comfortable for you, because if you had 10 properties and you were spending, I don't know, $50 a month out of pocket, and this is a really ideal sort of scenario.
Yeah.
Right. To achieve 10 properties is still difficult. Right?
100%.
So let's
Yeah.
not get carried away.
We're just making up numbers here.
We're just making up numbers.
These
we're
are
just making
arbitrary
up
numbers.
here. Let's say I'm paying $50 a month out of pocket.
Yeah.
On interest only. That's just $500 a month. Right. Which for the average person,
It's
like,
not too much.
if the expenses are low, 500 a month is achievable. Right. That, along with, like I said, rent vesting, having just living in the place that you want to live, living in your dream home, but maybe paying $700 to $800 per week in rent, right? Which, like I said, $700 to $800 per week, 3,400 or so a month, right, is still lower than your principal and interest mortgage repayments on your own home, right? So that's where it comes into play, where like you have to look at the costs and benefits, because the average Australian should be working to beat that wealth disparity that we are facing, right? The last thing you want is that you buy, or you don't buy at all. The worst thing would be to just not focus on wealth accumulation at all. Right. And it's good to see that a lot of Australians these days, that at least they're putting their money into stocks, they're putting their money into shares.
But there are better avenues.
I wouldn't say better avenues as well, right? There's no, like, we see people all the time putting money into crypto.
That is true. That's true.
And the returns are crazy. But also the downsides are also crazy. It's more, I would say, property. Property is one of those things where we discussed earlier. The accessibility is quite difficult, right, in terms of the deposit. But there are avenues to get you there. But if you get in and you do the first property correctly, that sort of trajectory where
Kind of just sets you up.
it just sets you up,
Right.
Because from there you'll always just have that equity build up, and you know where you're headed.
Yep.
Right. Like, even on a bad year, if you're making maybe like 5% like growth, that's still something, and you know you've got that asset there, versus like a share where a company could just collapse. Right. So there's no, I would never say that a certain way of investing is better than another way. Right. But it's more about property is, you've got an asset there that's attached to your debt.
Yep.
And that property has the potential to generate income. And there are different ways to generate income. You have your long-term rental. There are people who buy beach sort of properties that put them on for Airbnb. Right? We just had a client come in that was making close to $20,000 per month.
Per month.
Per month.
From
Which
an
is
Airbnb.
insane. From
a
an
rental.
Airbnb.
Okay.
In Gold Coast.
Okay.
Which is beautiful. Right? It's a different avenue altogether. Right? And it's about understanding the market. It's about understanding what do people want to pay for. Right? Like, when you're doing a long-term rental, it's very much about ensuring that sort of homely sort of feel.
Yeah.
People use Airbnbs. Some of them use them as like a short-term rental. Some of them use them as holiday homes. So it's about designing that the right way. But it's about like understanding what people will pay for and buying that. So we come back to you wanting to buy in Parramatta, the place you were living in.
Yep.
Right? Why exactly do you want to buy in Parramatta?
I've lived there. I'm familiar with the place. I know people. There's a community there which I'm attached to.
Yeah.
I don't really want to move out, so I have to learn, going to and fro, like best routes and stuff, new public transport, etc., etc.
Yeah. Now, if I told you today, because, like I said, you could borrow potentially around the 500K mark.
Yep.
Right? For a place to live in. You could avoid stamp duty. You could get in with pretty much no deposit at all.
Mm-hmm.
Right? So you could buy, let's just say, like a 500K place, just 25K.
Mm-hmm.
Right? So that accessibility is already there.
Yep.
Right? But if I told you that you could do this, or you have the option to accumulate wealth, right? If I said that, yes, you could buy this 500K property, or you continue growing your income and you buy a few investment property, you buy maybe just one investment property and you start building that up, right? And you let that grow, right? And there are different avenues. We can actually talk for hours about this in terms of how to invest, right? Because there are ways that you can buy properties under different structures as well. And I don't want to overcomplicate this, right?
Perhaps for another episode.
Probably for the next episode, right? But there are ways you can buy properties under other entities as well. You can set up trusts. You can set up companies. You can set up your own super funds to buy properties under them. And those properties, effectively, if they are self-sufficient, if they are profitable, they don't affect your borrowing capacity whatsoever. Your personal borrowing capacity is still protected, right? Which we'll touch on more in the next episode. But effectively, there are just many avenues, right? And that's the main advantage of really coming to us and understanding where you're sitting. And we tend to try and build a 10-year plan for all of our clients. We tend to say, where do you want to be? Yes, this is your dream home, and yes, we will help you achieve it. And if that's what you want, we will get that for you. As long as you fit the criteria for it. But what else do you want to achieve? Do you want to retire in the next 10 years? Do you want to have 5 properties? Do you want a passive income of 200K a year from just property by the time you retire? Because all of these things come into play. Right? So I think that's a big part of it. Right? So it's just more about understanding every client's personal goals. There's no wrong way and there's no right way, effectively.
But it just depends on the scenario.
Exactly right.
I think we're coming close to the end.
Yeah.
Can I just run it back for you and maybe just provide a summary for our viewers? Essentially, the key talking points thus far, and what maybe people can look out for in the future.
Yeah.
So, from what I understand and what you've explained, thank you for your explanations, accessibility for younger people trying to enter the housing market, the property market, has increased considerably in recent years. So there's different ways that people can access it, not just deposits, but there's also government schemes which also eliminate many of the cost burden associated with entering the housing market. And there's also different ways where other entities or other individuals can act as guarantors.
Exactly right.
So I think that's one, very important, and that's a very optimistic look at things. 2 is there's a lot of schemes out there nowadays, ever since, I won't say ever since, but from the recent election, we've seen a lot of new schemes be introduced where younger people are incentivized in a way to try and get into the housing market, particularly to buy their first home.
Correct.
Now, from my understanding, you said, depending on an individual's goals, generally, I'd say, you would recommend that rather than looking at a first home as the primary goal or the first step you need to take, you would recommend that people look towards wealth accumulation?
Recommend's the wrong word. I think it's about coming to us and having that expert discussion.
Yes.
Having that consultation.
So pretty much make sure people are actually informed by experts in the field, such as yourself.
Exactly. Recommendation, we can only recommend once we've had that discussion about your personal circumstances.
Yeah.
Right? Because it's about, like I said, it's about understanding what you want. And it's about understanding if that's the right decision for you. Right?
So you can give that informed advice.
We can give that advice. Like you said as well, it's when you came to us and when a lot of our clients come to us, they don't know what's possible. They see a lot of different things out there. There's an abundance of government schemes. We've only touched on a few today.
Yeah.
There's the First Home Super Saver Scheme. There's the Family Home Guarantee. There's the First Home Buyer Grant for new properties. There's so many different schemes. And then each state has their own schemes as well.
Yeah.
Right. So I would never say recommend just by listening to this podcast. It's more about coming to us and having that consultation and understanding your goal. Right? Because if you are close to, like, if you've been working for several years, if you have hit many of your milestones already, you've hit your goals, and now you're saying, I want to buy my primary place of residence,
then that makes sense.
It's a different goal altogether,
yeah.
Right? Versus somebody that's coming to us in their 20s or early 30s that says that we want to build our passive income base. We want to build our wealth.
Then that's an entirely different goal. They're pretty much on two different ends of the spectrum.
Exactly right. And then you'll have those, like I said, we've got those top 10% of the wealth chain as well.
Yeah.
Well, where people have already accumulated the wealth under 35, they might want to buy their primary place of residence.
Yeah.
So it's about coming and getting that consultation, which our business does it for free, right? And understanding where you sit. Because there's no point in just entering the market without knowing what's out there and what's possible. Yeah.
Okay. So I'll rephrase what I was going to say then. Your business and your expertise as a mortgage broker, you would recommend that rather than people immediately jump on a decision, they have this, quite frankly, very important conversation and at least be informed by your expert advice before they approach a decision.
Exactly right.
Before whatever avenue, whatever goals it might be, at least they have the knowledge and perhaps even your help in deciding how to approach that direction as well.
Exactly, because it's buying a property. It's not a small investment.
Yeah,
it's not like putting $500 into a stock.
Yeah,
you're putting thousands,
millions even.
Potentially millions, right, into an asset. Now we did discuss that this asset usually has close to zero downsides.
But there's still downsides.
There is, but it's not just about downsides. It's about how can you get the ultimate upside, right? So when you come to our company, we don't only get you the mortgage. We don't only just optimize that for you. We look at your current portfolio. We see where you're at. We see how do we best optimize that. Then we connect you with everybody because if you're self-employed, you want a good accountant. Even if you're not self-employed, you want a good accountant. Because these investment properties, you want to claim all the tax benefits. You want to claim the depreciation. Then on top of that, you want a good solicitor. You want a good conveyancer to guide you through the whole settlement process. You want, if you're doing an investment property and you want to ensure success, you want a good buyer's agent, which will effectively find you that property that hits those targets that we talked about. Right?
Yep.
So you need all of that. And you can do it yourself. But we make it that one-stop shop where you learn everything here. And you effectively get that fully guided advice, the holistic advice, that once you leave, you're in a better position. And that's why we get so many return customers. A lot of our clients have come back for their second, third. We've had a client that's just bought their 10th property.
Ooh, wow, congratulations.
Yeah, absolutely. and they understood the market, right? So it's really about understanding what really is possible out there and coming to us for that consultation.
Okay.
So I think we'll wrap it up here.
Yeah, I think that's a good idea.
It was a great chat. It was great having you today.
Thank you for having me. Thank you for having me.
And hopefully our viewers did enjoy this because it's our first episode.
Let us know how we went. If there's anything in particular you would like Aryan here to talk about, perhaps in his next episode, maybe something to clarify. Let us know. If people want to connect with you, how exactly should they contact you? Is there any social media they should keep an eye out for? Is there any email, phone number? How can they get in touch?
All of that information will be available. We'll put it right here, so there's nothing here right now, but once this is uploaded, you will be able to see all of it. Email addresses, phone numbers, our website, and our social media handles. And our team is available every day.
24/7?
Effectively for our clients, absolutely.
There you have it.
So
there's another incentive to be a client.
So it was great having you here.
Thank you for having me.
We look forward to future chats.
100%.
We look forward to
future investments,
future clients coming in, future consultations, and helping Australians achieve their goals.